I'd attempted to get this out earlier, but there just kept being constantly new things popping up. One major theme that I'm going to be addressing for this report is how many long-standing geopolitical matters are all now truly coming to a head. Every time I thought I had what I wanted to say ready to go, something else would pop up pushing things along further. A new move in the global game board. But anyway, looking from an overall allocation perspective, I made some pretty substantial changes from the end of the year. I'm beginning to tilt more small cap. And while I'm remaining US focused, and continuing to be very cautious with foreign developed markets, I am quite positive to a great number of EM countries. This is the case across both equity and debt. We have seen some very large returns in emerging markets, but there still seems to be some persistent undervaluation, and with the geopolitical changes that are working in favor of many of these countries, changes in the dynamics of global commodity pricing, changes within shipping, and the new American foreign policy doctrine amongst others, many considerations for emerging market countries have only become more positive. Couple this with persistently cheap assets, and to me it seems like there's still enormous opportunity in emerging markets. Particularly for me, I'm paying a great deal of attention to Latin America. I'm not bearish toward large cap, although I do continue to be wary of the very high multiples in US markets. To a large extent, the very high multiples appear to be a result of multiple factors. One, the divergence between gap reporting and how modern, particularly technology companies, actually work. Enormous passive flows, the effects of quite cheap liquidity, the market becoming levered, and leverage rewarding leverage, creating a levering cycle. And with such low interest rates for so long, many investors have really been forced to go further out on the risk curve than they would have normally done. Yet still, I'm not viewing these multiples as a catastrophe, though I do imagine the probability of quite low long-run returns to be fairly high. Small cap has been secularly out of favor, the entire way that the economy has been geared, both on the government spending and policy side, and on the financial side, from the effects of leverage and passive flows, has made it so that theoretical small cap premium just hasn't shown up. There have been factor investors for decades hoping that that return will manifest, and it just doesn't. Well, we're seeing a very fundamental change in national policy as it relates to the economy. New trade deals, deregulation efforts, new government investment opportunities, and the new more favorable status of smaller businesses and industry. These all have the potential to unlock that return that's been bottling up within small cap for decades. Now, this isn't a short-term trend. This is something that I expect to be a factor that manifests secularly. The primary way that I am getting at this is by dedicating more time to bottom-up stock picking amongst small cap. There also tends to be far more mispricing opportunity within small cap because there are fewer eyes on it, fewer analysts. Yet when it comes to indexing, within my passive allocations, I have been increasing my allocation to the Russell 2000. Real assets have been very interesting over the past few months. Since the last time I've made one of these, gold and silver shot way up, shot way down, went up and down very violently, and seemed to go through a consolidation process. While on its own that was exciting enough, the even bigger story has been in oil. Now, from my own analysis, oil looks far too overvalued. Going back to some of the videos I put out and some that I still hope to put out, it has been my conclusion that this operation in the Middle East is leading to a fundamental restructuring of global energy markets and flows. For nearly the past century, financiers and particularly insurers have been able to make themselves some very nice returns off of the volatility in energy. This volatility has been exacerbated by the chaos agents of the region. Chaos agents like the Houthis, Hamas, Al-Qaeda, ISIS. We all know these agents. And yet, quite notably, the IRGC and Hezbollah. Hezbollah, it's worth noting, is not simply a player of regional militants. Hezbollah is a globally integrated financial, political, and smuggling organization. Hezbollah is a much more serious player than many in the West are aware of. At the same time, this volatile market has been held captive to a series of choke points. points like the Panama Canal, the Strait of Malacca, and the Strait of Hormuz. Well, a few very curious things happened over the course of this recent little war. One, amidst all the concern that the Iranians would lock down the strait, the first real move was the insurers, particularly the reinsurers, suspending coverage, forcing shippers to cease transiting the Persian Gulf. In response, the American government offered its own insurance. The large insurance players, particularly those within the enormous Lloyd's market, then began to apply some pressure. Not expecting this response from the White House, they began to threaten shippers. Take that insurance and you'll never get another Lloyd's contract again. Yet, ultimately, they capitulated. At least, in great part. Just how much money has been made off of the persistently agitated chaos across the oil-producing regions? Just how much money has gone to these insurers with very old relationships with these agents? The global chaos premium has been a very cozy arrangement. Non-state actors gin up chaos, pushing up energy prices. This energy then must transit global choke points. These choke points then turn into toll booths under the thumb of the global insurers who have relationships with those chaos agents. And the United States Navy keeps it all free, spending blood and treasure so that financiers in London, Paris, Toronto, and New York can live the high life while young men live in bunks below deck. And that's if they're not the ones getting shot at. Well, this arrangement proved to no longer be satisfactory to the Americans, and what we have seen over the course of the past few months has been an ending of that system. We have seen many moves that back this up. One, when many began to fear that now finally the Iranians may have enough strength to close the strait, the Americans did. This then immediately put pressure on the Europeans, and while many looked to the Chinese and the Russians, wondering what they would do, the answer was a resounding nothing. The Europeans were proven to be weak or otherwise duplicitous. The Chinese and the Russians were proven to not really be friends with the Iranians, but once again just good geopolitical actors. And the world saw the Arabs throw their hands up in the air and say, all right, we've had enough of this. And so the Arabs will be forced to watch over the Persian Gulf. They will now have to figure something out. Meanwhile, the Iranians are staring down the threat of their pumps no longer working, a problem which could cripple their energy production for maybe even decades. The insurance oligopoly was shown to be less important than it thought it was. And very interestingly, the spread between WTI and Brent reversed for quite some time. There was a much stronger bid on the market for real, good-for-delivery, physical barrels of American oil than there was for the benchmark financial contract oil in the London futures markets. But it doesn't stop there. We've begun to see a divergence in energy markets around the globe. Now, does this mean globalization is breaking down? Well, perhaps it does, but secondarily. More so, what this is showing is that the real demand for real commodities in the real world is starting to take over from hypothetical financials. Cash-settled futures markets just aren't going to be as important in the future as they have been for the past few decades. And this moves quite a lot of pricing pressure to the United States. Right now, there are some financial players who still need those futures prices up. There are players who very much like the old arrangement of chaos agents, insurance premia, and global toll booths, who are hoping to hold on for as long as possible. And right now, the ever-jittery market continues to be freaked out by the war in Iran. A war that for the first time in a century has gone against the prevailing Anglo-American establishment global rules-based order. And yet, the final straw that really gives us an indication of where the world is going, in only the past week, the United Arab Emirates has announced that it will be leaving OPEC. The UAE is vital for OPEC, and for around the past decade, Dubai has been the place that globalist finance has been attempting to flee to, while cities like London, Toronto, and Paris wither away into irrelevance. Yet, clearly globalist finance is not winning this one, and the Arabs who actually live there have decided that they have had enough of the cartel. So now energy production looks like it is going to be based on the actual industrial needs of sovereign nations. The United States is securing its position over the Western Hemisphere, and if the project in Venezuela is anything to go off, which I very much expect that it is, then this confluence of the breakdown of the old extraction system and the ramping up of the new post-globalist industrial production system means that once the fear subsides, once there's just a bit more clarity, and as these big levered players in the Brent market pull back as they have to, we are going to find that oil should be worth a whole lot less. Now, there are still some geopolitical risks that need to be addressed, and personally I've been operating under the expectation that it's quite likely that there will be another round of serious combat in Persia. Yet, this is short term. There most likely will be signs as to when this massive spike is reversing. I haven't entered into a bet against oil prices yet, but I fully expect that I will be. And for now, I have been trimming some of my energy equity exposure, and I'm just keeping my eye peeled for a proper entry point. Yet it is my very firm conviction that over the coming years, oil is going to become a whole lot cheaper. Not just going back down to where it started, but dropping well below that. Over the medium to long term, I expect very cheap oil. I continue to have precious metals and gold overweight. I feel more confident in gold, but do expect that we will see another sharp run-up in precious metals. I currently have positions in silver, platinum, and palladium. Yet these positions are much smaller than they were last year. I've trimmed back gold as well, yet gold still remains a very fundamental part of my allocation, and one that I expect will be the case for quite some time. The market for gold seems to be very closely linked to global dollar liquidity, and there are some real concerns I have with that liquidity. A global dollar liquidity crisis could result in quite a sell-off in gold, yet over any sustained period of time, I believe that gold will continue to act as one of the only true hedges against the global financial system. So for the short run, I'm not quite sure where gold is going. I've mostly been selling puts on gold equities, perfectly comfortable taking some short-term losses at entry points that I am quite pleased to buy at. I certainly do not suggest that one be short gamma for short gamma's sake, but since there's no particularly pressing gold bull run that I'm expecting, and my outlook has shifted to being more long-term positive, I have become quite happy to accept premia from selling put options on gold equities that I would be very happy to buy into. Debt is in an odd spot. I've talked about the situation within private credit in some of my earlier videos, and I am very cautious with direct lending. And I'm also not very satisfied with current credit spreads that exist within broadly syndicated credits. There's just a great deal of risk and uncertainty that doesn't look to me to be getting adequately compensated in most of the credit markets. Yet that all being said, there do appear to be some real opportunities within emerging market debt. This lines up quite well with the opportunities within emerging market equity, quite frequently within the same countries, and particularly Latin America. I've talked about this in much more depth in my last one of these videos. I have increased my exposure to emerging market debt, yet at the same time I've pulled back from many credit assets, and have been particularly bearish about assets like BDCs, which are worth looking at. Some of those losses are substantial. I very much doubt that we're out of the woods yet, and it seems to me like the place where this financial cycle has most overextended was within private lending. Eventually, every credit cycle, every financial cycle, every big picture social cycle must come to an end. And it's always some variation of the same thing. The promises made within the story of the last system prove to be impossible. The promises can't be fulfilled. The story found to be a lie. Now this appears to be those enormous returns that were promised to investors within products like direct lending funds. Continuing with the big picture macro perspective, I remain very weary of developed market sovereign debt, and so I really haven't made any changes there. Sovereign spreads between the US and United Kingdom, the US and France, and the US and Germany are all entering into a very dangerous place. Historically, whenever credit spreads have gotten this far, actually, not even this far, there have been very serious political and financial ramifications within Britain. We've blown past the point that historically has led to crisis, and really there's just no way that these government systems can keep on going. There's just no way I'd be willing to take on the risk of something like a UK gilt or a French OAT. And if we look at the German Bund, it remains artificially far too overvalued. There appear to be some warning signs of a global dollar liquidity crisis, and in such a crisis, one would expect to see things like private credit, European sovereign debts, and Eurodollar bank portfolios coming under enormous pressure. Right now, there just isn't that much within the credit space that I like all that much. This could be a good time to be in cash. For that purpose, I have put cash as much more overweight than usual. Yet at the same time, there do appear to be some real opportunities, even within government debt. Yet that mostly exists within emerging markets. I have increased my position in agency MBS, carving up a pretty good sized position over the last year in AGNC, and continuing to buy in on down moves during the first quarter of this year, but that's a bit of an outlier. By and large, I have very little credit exposure, and if anything, this is a place that I'm watching very closely for a true crisis to emerge. Regional allocation doesn't diverge that much from what one would expect. I remain broadly positive to the United States and the Americas. The majority of my positions are United States domestic, and the majority of my emerging markets are in Latin America. Europe I remain quite bearish toward, and this is a very long-term perspective. Yes, there quite likely are going to be periods of opportunity in Western Europe, but the big picture long-term structural problems are just too substantial. I can't get positive about it. But Eastern Europe is a very interesting different matter. There are some very, very good, very, very cheap assets in Eastern Europe. Yet the big thing that's going to be key to watch there is the development of the Russo-Ukrainian war. Recently, there have been some statements out of both the American government and the Russian government that look more positive than usual with respect to the war. There are some pathways that lead to a reasonable resolution, but there is still a very real risk that this conflict will be pushed to escalation or continuation. Still, that all said, Eastern Europe has some real opportunities, and so I think it could be very worthwhile to take a look at Eastern Europe. Cautiously, yes, but with an open mind. The Middle East I'm a bit bearish to neutral on. Now that's for the obvious reasons. Yet more than that, many of the sovereign investment projects of the Arab kingdoms just really haven't panned out. Yet still, the negative sentiment may be overblown. In my analysis, the conflict in Iran appears to be more under control than it would seem, and could end more quickly than one might expect. So if I had to bet over-under, I would expect that things are actually better with respect to that conflict than broad sentiment believes. Asia is very tricky. For the past year, I have had a quite larger than usual allocation to Japan, and it seems to me that they are undergoing a process of normalizing their economy. There is some very real opportunity in Japan, although I remain currency hedged. China is a trickier matter. They have some very real problems and some very real opportunities. It seems to me like China has traded at a persistent discount that is not warranted. In terms of a fundamental analysis, I believe that Chinese equities are undervalued. But here's the thing. That sort of value philosophy requires there to be a catalyst to get the assets up to a reasonable price. There would need to be a narrative change with respect to China, and it's not quite clear how that's going to happen. And so it seems to me that that persistent undervaluation is likely to continue to be persistent. Maybe buying over a very long time horizon would be reasonable. However, then we begin to run the risk of what the Chinese government is going to look like in the future. People might be too bearish on the Xi Jinping government. That's quite possible. It seems to me to be the case. But we don't know what the next government would look like. There are some rising within the Chinese government, and particularly within the PLA leadership, who are far more aggressive and much more in favor of cutting China off from Western capital. This would bode very poorly for Chinese ADRs and the Hong Kong equity market. And so it seems to me that there are opportunities in China. There's some that are just too cheap. But overall, it's really difficult to get excited about China because it's difficult to imagine the narrative changing substantially enough to result in a fundamental reevaluation of its market. China's risks are very real. Its opportunities are very real. And so again, this could be one of those places where a stock picker can shine. But this is certainly a place to take the idea of value traps very seriously. Real estate isn't all that exciting to me. I do have a positive tendency toward industrial and storage, both in commercial warehouses and in personal storage. And I've had a generally positive sentiment toward personal storage for years now. It's just been a really great performer and a really great opportunity persistently, although some of that does appear to be subsiding. Still, within real estate, it's one of the areas that I like the best. I do have some real optimism with industry, and would tend to be favorable there. There look to me to be some regional and city-by-city plays in terms of office, retail, and residential, but as a whole, I still don't feel great about them. Somebody who's really good in the space can almost certainly find some very good distressed opportunities within office, but that will not necessarily translate into a sector-wide boom, nor even necessarily moderate outperformance. So real estate I still feel kinda about. With office and residential, I tend to believe that making regional bets is the best approach. I'm still generally positive towards southern and southwestern opportunities, even after the overbuilding that we saw in the first years of the 2020s. And while I'm quite bearish with respect to California, it seems to me that there are still some very cheap opportunities around San Francisco and Silicon Valley. But cities like New York and the traditional East Coast hubs, I'd still be far too weary of, and see industrial and storage as having the greatest opportunities, even with personal storage losing a little bit of its shine. I have seen some arguments for leisure outperformance, but there are just too many risks in the global economy right now, and while I have a generally optimistic outlook for the American economy and the American lower classes and consumer, that's going to take some time to manifest. I can't bring myself to be too positive with respect toward leisure, and really, there isn't all that much within real estate that I can get much excitement about at all. Still, no real hard pessimism. And last, let's look at hedge strategies. Buy right income generation strategies I have as neutral. Now, one thing it has going for it is that while I have more uncertainty about beta than usual, meaning that giving up some upside in exchange for the income generated by premia could seem reasonable from that perspective, I also don't particularly have a reason to expect outperformance. This is certainly a market where you want to be cognizant of your gamma exposure, and I have been using a buy right strategy for some of my positions. Over the past few months, it's been treating me pretty well, and I expect to continue. But right now, this is just one part of a much larger portfolio. It seems like a perfectly reasonable strategy to me, and within the scope of my portfolio, I like what it adds. But there's just nothing that really moves the needle one way nor the other. And at the same time, I don't expect a buy right strategy to add undue risk. I have a moderately positive sentiment toward market neutral strategies, and that's really just because I don't have much confidence in this market. Currently, I remain beta positive, and I think that this is a good time for idiosyncratic risk and returns. However, idiosyncratic risk and returns are getting more difficult to predict these days. In theory, I think that that's a very good approach, but it's also worth being a lot more cautious than in the past. Amidst all the geopolitical chaos, would gold have been a good investment? Well, the answer would seem yes, until the demands for global dollar liquidity got in the way, and there was a sizable sell-off in gold and silver. How about tech? Were tech companies a good bet? Well, some of the time the answer has been yes. Unless, of course, the market is freaking out about SaaS, in which the answer is no. Well, yes, for some companies, but no for some other companies. Really, I just have this here as a matter of caution. It seems like a reasonable strategy to me, and my portfolio has become less correlated with US equity markets than in the past. But it's also a time for caution. Managed futures I'm also generally positive toward, but another bit of caution on this. I very much expect that many of the rules that the market has come to learn with respect to how commodity futures move are not going to hold as we go forward into this new era. If we see a substantial shift in how global oil is priced, a shift from pricing dominance in the London Brent market to the US WTI and regional markets in the Middle East and China, then many of the rules we have come to know might just fly out the window. Gold and silver, for example. Those are no longer following the old rules either. There are substantial risks in the global fertilizer and agricultural markets. Somebody who is really good at playing the futures should have tremendous opportunities right now. But at the same time, I fully expect a very large share of the market to do much more poorly than usual, as many of the old trading rules just no longer hold. The two that I've rated the most extreme, those being very underweight and very overweight, are carry trade strategies and global macro strategies. As I've said before in the video, there are some very real risks of a global dollar liquidity crisis. One need only look at European spreads and curve shape. One need only look at the Japanese yen. One could look at the scramble for the exits in private credit. One should keep a close eye on the gold market, and most certainly, one should look at the SOFR futures. There are some very clear warning signs, and in such a liquidity scramble, carry trading could become very dangerous very quickly. And at the same time, many of the old funding currencies no longer are able to fill that role. Yes, I'm sure that somebody somewhere is going to be able to find a great funding currency and a great investment currency. But as a whole, this trade, I very much expect, will only get trickier to execute well. Even if one does find a good and seemingly reliable spread, there will almost certainly be more hidden risks within that trade than are visible on the surface. So now I just don't think is a good time for carry trading. The risk-reward profile just no longer holds, and particularly in a liquidity event, unwinds could get violent. Global macro, on the other hand, now is the best time to be a global macro investor. But one has to be good at it. If one can see this global game board, and one can successfully make predictions and execute on them, then there are real opportunities for wild outperformance. The tricky bit here is that understanding this global environment requires one to dispense with decades of collective and consensus wisdom. The old rules no longer hold. The global order is unraveling and becoming something new. What is that new thing going to look like? Well, I don't know. But in great part, this channel is dedicated to trying to figure that out. And as we have seen, it takes an enormous amount of work and being willing to be an alienated weirdo who is a bit disconnected from his peers. Being a global macro thinker in this environment requires perspectives on geopolitics, macroeconomics, political affairs, and social dynamics that would put one at odds with the worldviews of most everyone else. You will have to stand out from the crowd to an astonishing degree to be good at this. And as this is such uncharted waters, it will also most likely require several very large fundamental worldview changes. If someone has the temperament to do that, and is good at it, then he could set himself up to be very, very wealthy in the coming era. But most aren't going to be able to do this. Still, periods like this, periods where the global order unwinds, where the rules of old no longer hold, where entire macro systems are reset, these are the times where the global macro investor sets himself up to be on top of the next order. So let's look at some of the opportunities that are out there. Oil is very interesting right now. Oil is almost certainly overvalued, but it is being pushed up in the financialized Brent futures market and remaining elevated on fears from Iran. There could quite likely be further chapters to this conflict, and I would be very reluctant to enter into a short or put position on oil quite yet. But if one can keep an eye on the subtle signs out of Iran and across the WTI and Brent markets, there should be some forewarning prior to stable down moves. The global choke points are being taken over by the US. The Donroe Doctrine is developing Western Hemisphere energy under the Sovereigntist Development Partnership model. The US trend is for deregulation. The chaos premium and agitation agents in the Middle East are being degraded and their funding sources cut off. The US has taken over insurance and transit in Hormuz and has demonstrated capacity for dominance in the region. And last but certainly not least, with the UAE leaving OPEC, the oil cartel is almost certainly falling apart. Long-term, and most likely medium-term, oil prices need to come down. Not only back to where they came from, but much lower than that. I expect that if one is careful, there will be opportunities to bet against oil price. However, a very interesting one, and something that I believe is a very powerful indicator for the current state of global finance and the geopolitical game board, is to watch the spread between WTI and Brent prices. And as global commodities enter into a new order, there should be opportunity to play the spread. Let's take a look at our longtime friend, gold. There are short-term risks to gold. Global US dollar liquidity risks place gold at risk for further sell-offs, or even a medium-term bear or consolidation market. While there is risk in the short term, there also isn't a clear bear indication, and there is no particular reason to fear any future price declines to be very large. Over the medium to long term, gold remains a unique asset in the global economy, and will almost certainly only increase in relevance. The likelihood of an increase in demand for gold in a recollateralizing global economy that is shifting its philosophy to a hard asset approach is overwhelming. The traditional pressures that have kept gold down no longer are present, and selling pressure seems to be transient from uniquely short-term phenomena. The reordering of the global system is very favorable for gold, and the most powerful players are now incentivized to be long the monetary metal. There is a clear long-term direction of travel. Up. I believe that gold can be played in a variety of ways. The spot market, the futures market, options, gold equities. Really, there are many ways to go about gold exposure, ones that should fit a great many different portfolios. Let's look at the Russell 2000 and small cap. US economic policy has been substantially changed to favor smaller American companies. While many may raise concerns that the actions of the US administration are temporary and do not have the support of the legislature, many of these changes cannot be reversed, not because of law and procedure, but because the economic system is changing along with it. Deregulation, trade deals, public sentiment, new financing facilities, downward pressure on energy and commodities, a quite likely future decrease in the unpredictability of energy prices and associated volatility, and sufficient shifts in what younger generations are going into, motivated by, and excited about, all point in one direction. The secular undervaluation of small cap is beginning to end. Large cap has been pushed up by consolidation, passive flows, cyclical leverage, and government and global policy favorable to large firm capital. None of these forces can be sustained much longer into the future, and have begun to break down. As the world comes to see that the new American economic model is going forward, the choice to invest in American industry and dynamism will be self-evident amidst the ruins of globalist financialist capital. With such fundamental shifts in the winds, this persistently undervalued laggard has not only great opportunity to outperform, but has a long-standing empirical advantage which has been suppressed for decades in the post-crisis world of coordinated central bank globalist finance. It is quite reasonable to suspect that, at least in relative terms, the suppression of small cap will reverse akin to what happens when one attempts to hold a beach ball further and further underwater. Small cap is cheaper. The social order is changing in its favor. Inputs are becoming more available and reliable. Policy is shifting in its favor. And the era of artificially cheap leverage and passive flows is reaching its end. The small cap expected return premium will return, and most likely very soon. When it does, it will be with a vengeance. I've been accumulating Bitcoin for the past few months, and I am far from done. Bitcoin has shown itself to be very closely tied with US dollar liquidity and credit availability. Following the enormous run-up into 2025, the reversal has been enormous. Yet, this is quite common for the asset. As the asset has integrated itself further into the global economy, many of the larger players dependent on the old monetary order have been pulled in two directions. The impulse and incentive to squish down the novel currency, and the desire to profit from it. The interplay between these motivations has been a delicate dynamic, seeing efforts to suppress Bitcoin come from the same players building investment and credit products out of it. As the Eurodollar credit system became more strained and the tariff system came into play, we began to see strain in the Bitcoin markets. The grinding end of the Japanese yen carry trade only exacerbated this movement down. It is quite likely that the excitement that pushed up Bitcoin following the 2024 election contained within it excessive optimism. Bitcoin is no stranger to excessive optimism, and there were very real, fundamental structural reasons to be bullish. However, this move cannot be attributed purely to retail optimism. The final nail in the down move coffin was the start of the war in Iran. As there was a scramble to move wealth through the channels the IRGC had maintained with global players since the days of Iran-Contra, Bitcoin moved as if players needed to move their money out of such funding channels and into the West. Yet as the conflict went on, the price action ceased mapping to geopolitical risk developments, and instead began a slow rise upward. This asset has a history of moving heavily with momentum, and momentum could be very valuable to watch. It could be quite difficult to get back into 6 digits in the short term, as the global order liquidity risk and larger market sentiment concerns may act as a drag, but the backdrop is there for a momentum run to yield a substantial up move. Over the medium to long term, however, Bitcoin is unlikely to go anywhere, and there is a very good probability that it will head much higher before it stabilizes into a mundane asset. I've been nibbling into Bitcoin for the past while, and more recently have been making larger purchases. I will be weary if it gets high up into the 90s, but on a substantial momentum move, still hanging out somewhere in the 80s, I could even foresee myself buying into call options. I've continued to have a large allocation to emerging markets, both emerging market equity and emerging market debt. Equity through fundamental stock picking, and debt by the use of bond funds. As the geopolitical order moves from the rules-based order to the emerging system of sovereign spheres based on mutual trade and development relationships, many old winners will find themselves to be losers, and many losers to be winners. Developed government bonds have for a long time been able to enjoy a premium by virtue of forcing banks and large welfare states to absorb the borrowing, driving down yields well below where an adequate compensation for risk should suggest. The German Bund, for example, is absolutely not hundreds of basis points safer than US Treasury debt. These developed markets, in fact, have only been able to live so lavish owing to US military protection and the ability to extract American productivity via offshore US dollar lending and the rehypothecation of US dollar assets. These bonds, like the Bund, Gilt, and OAT, only even exist because the US Treasury exists, and now the world order where America bleeds and pays for decaying European welfare states is over. There are winners amidst the shift. Undervalued emerging market assets. This past year, we have seen a substantial revaluation of Latin American equities. This revaluation has come at a time of substantial political changes across the region and the instantiation of the new American hemispheric geopolitical philosophy, with American support and involvement no longer as the dumb muscle of global debt extraction via the IMF and World Bank, but as an actual development partner. These long-depressed assets present vastly asymmetric upside. Latin America is the first among these such countries, yet this applies across commodity-producing emerging nations. As global commodity markets are revalued and flows rerouted, the beneficiaries will be commodity producers like those in Latin America, Asia, and Africa, while the financialized old world, the loser. As this shift becomes something which cannot be ignored, capital will need to reassess where safe actually is. Over the coming years, it is quite reasonable to believe that resource-rich nations like those in Latin America with financial and geopolitical support from the United States, countries with very cheap debt and equities, countries who are now being able to access the wealth of their resources and grow industry in a way that they never have before, all while new financing opportunities come online, are a much more reliable place to park wealth than decaying welfare states with internal social crises like those in Western Europe. EM could very likely outperform not only as a secular trend, not only as undervalued assets with higher required returns, but as part of a fundamental rotation in what safe means for global capital. I had written about biopharma opportunities last year during one of my periodic reports, and those expectations appear to be coming to fruition. Following the volatile years beginning in 2020, biotech, small pharma, and related biopharma businesses have seen wild enthusiasm followed by a sense of hopelessness as drug trial data underperformed expectations, cash runways burnt out, and investors ceased extending financing as the dream of this new age of hacking the body fell flat. There has been a lull in the sector for the past few years, and that has left the market with many very good and cheap opportunities, yet few catalysts for proper price discovery as a cloud of pessimism still hung over the market. This appears to be reversing, with new enthusiasm entering the space. The explosive success of GLP-1s marked a significant turning point in market sentiment as we entered 2026. Though the enthusiasm had not returned to its previous highs, what appears to be dominant is a sort of cautious wait-and-see optimism. The market is once again willing to reward companies who make promising products, but they are demanding more proof than before, making stock price movement extremely sensitive to the success and failures of drug trials. Fortunately for the fundamental investor, a great deal of investment in this space also comes from investors who don't look all that closely at trial data. While there certainly are buy-side managers who employ doctors, biologists, pharmacologists, chemists, and relevant experts to investigate small biopharma company promises, a great deal of the capital which floods into the space does so haphazardly, on blind sentiment, and often without reading data all that closely. As wild as it sounds to say, in the same market where trial data results in wild stock price swings, much of the theory and empirical study work put out in the space is not accurately reflected in share prices. The mechanism of a drug could show categorical failure in one company's trial, and yet we may see very little change in the price of another company whose only product is a very similar drug going through trials. Often the market rewards or punishes trial performance based on general sentiment, behavior more akin to how people get worked up by headlines and don't even read articles, than to careful scientists reading over the data. As so many small IPOs have flooded into the space, this sector has an excess of stocks to comb through. Yet this combination of emotional swings, limited sell-side analysis, and improper digestion of data has left this segment of the market with the excellent benefits of both being filled with extreme mispricing and investors who are willing to reward even small positive developments quite sizably. The market is willing to buy biopharma, but so far it seems unwilling to price properly until too late. This inefficiency lag in an improving sector with substantial breadth is an unusually large opportunity that should yield excellent results for one who can take the time to carefully review the data, theory, and just keep a level head. I've been playing this sector by selling put options and going long on individual stocks. Originally, before I got into economics and geopolitics, I had studied chemistry and biology in college. Now, that certainly doesn't put me up there as some sort of pharmaceutical expert. But even just a reasonable level of knowledge in this space can give someone a very surprising advantage. Really just reading the data carefully, thinking through the mechanism of action of a product, and taking the time to assess what just seems reasonable can lead to outperformance. There are absolutely incredible pharmaceutical investors out there, and there are funds who employ incredible minds, including those with deep expertise in the field. But some of these companies are very small, they don't have many eyes on them, and quite often a lot of their pricing comes from vague sentiment, blind purchases and sales of the sector as a whole, and really just not very careful investing. So for someone, particularly someone who has an interest in such topics, this can be a fascinating sector and a place to get some real alpha. CAR-T, monoclonal antibodies, non-opioid analgesics, and for as much of a roller coaster ride as it's been, tryptamine and phenethylamine therapeutics have all been areas that I've been quite interested in. I haven't often invested in larger pharmaceutical companies, and those that I have sold out of. I had a moderate position in Johnson & Johnson last year, and a few years before that Novo Nordisk. Most of my positions have been in much smaller companies. The only other large one of note was a position in Pfizer last year, a position which ended slightly up, but was overall just a disappointment. One of my larger positions in the sector that I've been holding for a while has been GH Research. I've been in that for about the past year, and I've sold some put options on it as well, but I've now sold out about half of my position. By far the biggest failure I've had in this space has been Resolute Inc. Fortunately, my position was fairly small when it suffered its very large sell-off, though I did have some put options assigned to me. It ended up being a really good lesson in working the options, and holding steady after what looked to me to be an overreaction. By very carefully working the options and buying back in, I was able to dig myself out of that loss. But just look at that chart. This is a really good example of how nerve-wracking this sector can be, and why it requires a lot of calm. And the long position is now up about 78%. Overall, that position has been quite successful. This is a space that I have found tricky to figure out when to leave. Yes, it certainly can be approached with fundamental analysis, but since the prices move so wildly and it is so very narrative-driven, it can be really tricky to say, yes, that's the appropriate present value of future cash flows. To address this, I very frequently sell calls to get out of these positions. As another example, a quite nerve-wracking one has been ticker KYTX. I've used both a long position and options on that one as well. But after experiencing quite a run-up, I've now gotten a bit of a nervous, should I just sell right now? What if it goes back down? Ooh, should I sell? And the way that I've personally addressed this is that after a sufficient run-up, when there appears to be some reasonable convergence between narrative, reality, and market price, I begin selling off fractionally. Usually I sell either a quarter or a third. So much of this is narrative-based, trying to keep my finger on the pulse of what market participants are thinking. And then after I've trimmed, sell call options, and keep a close eye on how things change. In the past months, the tickers I've most recently entered are ABCL, ALLO, APGE, JAZZ, and KRYS, while those I've most recently left are DFTX and BCAX. Currently, my largest position is KYTX. I could certainly make a video on this topic at some point. It's something I've become increasingly interested in over the past couple years, and I really haven't discussed it much on this channel. But I very firmly believe that there's incredible opportunity here, and it has been one of the better performing parts of my portfolio, outperforming the market by a great deal. Within my own portfolio, I've been taking smaller positions, generally holding only around 10 different names, but the number can vary. Some I will take much larger positions in than others, varying greatly based on conviction, asymmetry, and margin of safety, if there is one. Most of this exposure has been from long positions, though quite a lot of it has been selling out of the muddy put options. This can be particularly risky in this sector, as an event like missing a trial can mean a very rapid drop in price, so one has to be very mindful about those strike prices and dates. But there is good income premia to be made, and so far this has been a portion of my portfolio that has been outperforming quite well, and at the same time certainly one that has been done very carefully. I have an essay that is going to go with this report, but I'm still finishing that up and I need to record it, so that will come out as a separate video. This will also all be available on Substack. So the last thing I have for this report are some of the key indicators that I've been looking at when trying to stay on top of the global game board. I believe it'll be worthwhile keeping an eye on sovereign spreads. A few that I'm looking at are the US Treasury versus the European sovereigns, particularly the British Gilt, the German Bund, and the French OAT. But I'm also looking at some internal spreads, particularly the German Bund versus the Italian ETP, the French OAT versus the Italian ETP, and the British Gilt versus the German Bund. It's also been very worthwhile looking at some of the emerging market bonds, particularly those in Latin America. And the last big major one is the US Treasury versus the Japanese government bond, and the Japanese government bond versus the European bonds. And in a very fundamental sense, this can tell us who the world has confidence in. If, say, the Italian ETP reliably outperforms versus the OAT, then that's an indicator that capital feels better in Italy than in France, and it can as well tell us what governments may be in trouble. This has been a very interesting year for sovereign spreads, and these movements have lined up very closely with changes in global politics. I also want to note if there are any potential major events that these could be indicators for, and the biggest one here would be if a sovereign debt crisis were to emerge, say a widespread sell-off of some sovereign debt, and that capital seeking safety elsewhere. The spread between Brent prices and WTI. At a very fundamental level, this can tell us who has dominance in global oil pricing, with the big potential event here being that the WTI market takes pricing power away from the financialized Brent market, something which would be a very fundamental change in how commodities are priced globally. A world where the real demand for real physical barrels of US oil serves as the benchmark for global oil prices is a very different geopolitical dynamic than one where the futures in the Brent market dominate. Internal freight data in the United States is very useful to watch. There's a lot that we can glean from this data, but most importantly, it can be an indicator of how the US reindustrialization effort is going. Potentially, we might see that US reindustrialization is growing, or that it's slowing. It could also serve as a potential recession indicator. SOFR spreads are very valuable. This can show us the different demands for dollars around the world. This will most likely be one of the first, if not the first place, where signs of any US dollar liquidity crisis will emerge, and we can see where that liquidity strain is coming from. A potential very big event that this could point us toward is any US dollar liquidity crisis. I will be keeping a close eye on redemption requests for private market funds, following the substantial increase in redemption requests from private credit funds like Blue Owl and Blackstone. This is a really sensitive spot. Lending from private credit companies has become a core part of today's credit environment. If the ability for these shadow banks to lend were to go away, then that would mean a credit crisis, and there could be potential spillovers into the banking sector as well, making it much worse. This isn't limited just to private credit direct lending. There are concerns that I've had for quite some time in private credit as a whole, as well as private equity, and really the entire private market sector. This could show us if there are cracks emerging, and if in fact the shadow banking sector is drying up. How gold and silver move with respect to each other is another very interesting thing to watch. To an extent, silver does have a monetary quality, yet most of its market pressure is as an industrial metal, while gold behaves as a monetary asset. Watching the difference between the two can show us the relative demand for monetary versus industrial metals, show us where the buying and selling pressures are, and show us where that demand, lack thereof, or selling pressure is coming from. For example, a big surge in demand for an industrial metal is a very different thing than seeing the Chinese government all of a sudden start demanding and hoarding a large amount of gold. This could give us insights into the global recollateralization underway. It could be a very powerful sign in a global flight to safety scenario, and like others on the list, it could act as a recessionary indicator. It'll be worth keeping an eye on stablecoin adoption. Is the demand for US dollar stablecoins accelerating? Is it slowing? Who are using US dollar stablecoins? And are there any non-US dollar stablecoins that are growing in prominence? and this could give us great insight into the stability or instability of US dollars and US treasuries. As the nature of the US economy is changing, it will be worth watching changes in personal incomes across the economy. Are lawyers making more? Are wages starting to grow for machinists more quickly than financiers? Is the farmer seeing his income rise faster than the academic? This can show us where the demand is. It could perhaps show us where people want to work, if there is indeed reindustrialization underway and a change in the fundamentals of the US economy. Then are young people now more apt to go into skilled trades? Is that now where the good money is to be made? Are young people excited? And who is being set up to be the winners in this new economy? This can help us track the relative balance between the financial and the real economies, and as with many others, could as well serve as a potential recession indicator. And last, not least, but perhaps most arcane, watch the narratives. Yeah, there's no straightforward way to do this, but as has been a theme throughout all of my videos, there is so much power in just understanding what people think and why. If we can understand the stories that people tell themselves, we can understand what they might do. People attempt to live in stories. They try to act out their stories. And so as we go into this uncharted territory, think about the story that you tell yourself. Look around and ask, what are the stories others are telling themselves? And as always, try to differentiate between the narrative, the signal, and the noise. Well, I'll try to have the essay out shortly. The other series and standalone videos will continue as normal. This has just been a longer gap between videos than is typical, but should resume going back to how it's been. And I'll even try to be more rapid. There's more about the changing world order, more about the history of our philosophical system. There will be videos looking into the nature of power and the structures of our modern world. And really, we'll just continue our exploration of our system and how it works. It's absolutely fascinating. And if one can really understand our world and what's changing, then perhaps he can set himself up to be in a very good place in what comes next. So, at least for now, I hope this analysis of what I've seen in markets can be of some use. After all, this market is very bizarre. So many people I've heard are a little freaked out by this market. They don't know what to do. But if you're like me and driven by curiosity, it's a lot of fun. And maybe if we can understand it, and we can get just a little edge on what's going to come next, maybe we can win in the big game of market. So do like and subscribe if you found this useful. I'll be sending this over to Substack shortly, and I will have the essay that goes along with it. I'll be trying to start building up into other social media platforms as well, maybe exploring some shorter clips. But do hang out and check out the videos that are to come, and enjoy your night.